Welcome back to the deep dive. Today, we're going to look at a map of the world, but, well, probably not the one you had on your classroom wall.
Right.
We're looking at the map of money specifically, where the biggest banks in the world, think the next massive wave of growth is coming from.
And spoiler alert, it's not coming from Silicon Valley, and it's definitely not coming from Wall Street.
Exactly. We are talking about the frontier. And no, we don't mean space. We aren't talking about wagon trains. We're unpacking some major breaking news from February 3rd, 2026, involving the titan of global banking, JPMorgan.
It's a move that has flown a bit under the radar for the general public, but for anyone managing money, this is, well, it's seismic. We're looking at exclusive reporting from Reuters and CNBC Africa, and it's all based on leaks from insider money managers.
And the headline is what?
The headline is that JP Morgan is finalizing a brand new financial engine, the Frontier Market Local Currency Debt Index.
Which I have to say is possibly the least sexy name for something that might change the global economy.
It does have a certain dryness to it, yeah.
Frontier Market Local Currency Debt Index. I mean, it sounds like something you'd read to cure insomnia.
Well, our mission today is to crack that shell open, because inside that very dry title is a trillion-dollar shift in how the world works.
Right. So we need to figure out why a bank as conservative and, massive as JP Morgan is suddenly shining a spotlight on what we used to call risky investments. Places like Kenya, Vietnam, Nigeria.
And specifically why they're doing it now, because the timing here is everything.
Okay, so let's set the scene. JP Morgan isn't new to these countries. They've had indices before. I remember the NEXGEM index from back in the day. Is this just a rebrand, a fresh coat of paint?
No, this is a fundamental structural change.
Yeah.
The NEXGEM index, which launched about 15 years ago, was a hard currency index.
Okay, let's unpack that term immediately. Hard currency.
Hard currency just means debt issued in US dollars or euros. So if the government of Kenya wanted to borrow money from international investors back in 2015, they'd issue a bond worth, say, 500 million US dollars.
So I, the investor, I give them dollars. They promise to pay me back in dollars.
Exactly, which feels very safe for you, right? You don't have to worry about what the Kenyan shilling is doing. You gave dollars, you get dollars back.
But this new index is the opposite.
It's the complete opposite. It's a local currency index.
So now we're talking about buying debt in the Kenyan shilling, the Vietnamese dong, the Nigerian naira.
Correct. You are taking on the currency risk of the frontier.
Which intuitively, that sounds terrifying. I mean, we usually associate these currencies with a lot of volatility. Why would JP Morgan pivot to this now?
Well, there are a couple of big drivers. One is the macro environment. We've been seeing a slump in the US dollar over the last year, which makes local currencies more attractive. But the bigger reason is simply that the market has matured.
It's grown up.
It has, a lot.
Yeah.
We aren't talking about a few small trades anymore. There's an analysis by Neuberger Berman that shows tradable local currency debt in these frontier markets has trebled over the last decade.
Treble.
Yeah, it's now a $1 trillion asset class.
$1 trillion. Okay, that's not a niche experiment. That is a serious chunk of the global economy.
Exactly. And JP Morgan is essentially saying, look, this market is too big to ignore, and it's too big to not have a proper map. So they're drawing the map.
So let's look at this map. If I'm a money manager and I open up the prospectus for this new index, what am I actually seeing? What countries are making the cut?
According to the sources, you're looking at a club of about 20 to 25 countries. It's pretty exclusive. You can't just walk in.
And who are the heavy hitters?
The weightings, which is just fancy talk for how much influence a country has, they're expected to be led by Egypt, Vietnam, Kenya, Morocco, Kazakhstan, Pakistan, Nigeria, Sri Lanka, and Bangladesh.
That is a fascinating list. You've got the industrial engines of Southeast Asia like Vietnam, and then the demographic giants of Africa like Nigeria and Egypt.
And you've got Central Asia in there with Kazakhstan. It's a truly global South portfolio. But, creating an index like this isn't just about picking names out of a hat. There's a real danger in these smaller markets called concentration risk.
Right. I can guess what that means. If one country is half the index and that country has a revolution or a crash.
The whole index tanks.
Exactly.
If Nigeria, for example, made up 40% of the index and oil prices collapsed, everyone holding the index would just lose their shirts.
It defeats the purpose of diversification.
Completely. So they have to stop that. And the sources tell Reuters there are weighting caps. They're putting guardrails on it.
Okay.
One source mentioned a cap of 8% per country. Another document referenced 10%.
It's like a salary cap in sports. It doesn't matter how big your economy is, you can't dominate the team.
Precisely. They want a balanced diet. If
Yeah.
Egypt has a bad year, maybe Vietnam has a great one, and the whole ship stays steady.
Now, I also saw something in the notes about an entry ticket, a size requirement, and this seems like a pretty high bar.
It is. This is where we get into the plumbing of the financial system.
Hmm.
The sources say there's a minimum bond size requirement of $250 million equivalent.
$250 million. Why that specific number?
Liquidity. This is the single biggest fear for big investors in frontier markets. Liquidity just means, can I sell this thing when I want to?
Right. It's the difference between owning a stock on the NYSE and owning a rare painting. The painting might be worth a lot, but you can't sell it in 5 seconds on your phone.
That's a perfect analogy. JPMorgan is building this for massive pension funds, for huge asset managers. If they need to move $50 million out of Kenya on a Tuesday afternoon, they need to know there are enough buyers and sellers to make that trade happen without crashing the market.
So that $250 million floor is basically a guarantee. It's saying, don't worry, there's enough water in this pool for you to swim.
Exactly. And they also have a maturity rule. The bonds need to have more than 2.5 years left before they're repaid. They want stability, not some short-term IOU that's about to expire.
So we have the players, and we have the rules of the game. When does the game actually start?
It's moving fast. Discussions really heated up in the second half of 2025. The fund managers are expecting the formal structure to be presented around June of this year, 2026.
So just a few months away.
Very close. We might even get an official announcement as early as March, but the actual inclusion, the moment the index goes live and the money starts flowing, that's likely 2027.
They're laying the tracks now for the train to arrive next year.
Correct.
Okay, so that's the what. But I want to go back to the why. You mentioned the dollar slump, the market size, but I have to play devil's advocate, frontier market, and local currency. Those are two phrases that usually scream high risk to your average investor. Why are people clamoring for this?
To answer that, you have to look at what's happening in the rest of the world. The US, Europe, Japan.
Yields are okay, but they aren't thrilling. Growth is slow.
The stagnation problem.
Right, so investors have what we call yield hunger. They're starving for returns. And this new index, well, it's a feast.
Give me the numbers. JPMorgan estimates that this index will offer a pickup in yield of about 400 basis points over the standard emerging market index.
Let's translate basis points for the non-bankers. That's 4%, right?
Yes. So if a safe emerging market bond pays you 6%, these frontier bonds are paying you 10%.
Wow.
In fact, the data shows that over 60% of the countries in this potential index have yields over 10%.
Double-digit returns in 2026. That is incredibly rare.
It's a magnet. But here's the kicker, and this is the part that I think really shocks people. It's not just about the promise of high returns. It's about the history.
What does the history show?
If you look back at the last 8 years, which, was a crazy time for the world frontier market, local debt actually outperformed the mainstream emerging market local currency index.
Wait, really? The risky frontier stuff did better than the established players?
By almost 2.5 percentage points a year. And it beat the dollar-denominated bonds, too.
That feels like a paradox. We're taught that risk and reward are correlated. If it's safer, it pays less. If it pays more, it's riskier. You're telling me this is safer and it paid more.
In a way, yes. And this leads to what Rob Dreikanigan calls the underprice theory. He's a lead manager at Neuberger Berman.
Okay, and what's his theory?
Basically that the market was prejudiced. Investors looked at Africa or Vietnam or Pakistan, and their brains just screamed, danger.
Right.
So they priced these bonds as if they were junk. But the reality on the ground was that the economic management in these countries was getting better. The growth was real.
So the assets were on sale.
They were systematically underpriced. The investors who saw past the stigma and bought the local debt, well, they made a killing. And now JPMorgan is essentially institutionalizing that trade. They're saying the secret is out.
But I want to pivot back to that local currency thing again, because there is a safety aspect to this too, right? It's not just about chasing yield. I read in the notes that the World Bank is actually a big fan of this shift.
Right.
Why?
This gets to the structural health of the global economy. Have you ever heard of the concept of original sin in economics?
Sounds biblical.
It feels biblical when it goes wrong.
Yeah.
Original sin is when a developing country borrows in a foreign currency. So let's say you are the Nigerian government. You borrow $1 billion US.
Okay.
You have to pay that back in dollars. But your economy runs on Naira. You collect your taxes in Naira.
Right.
Now imagine the oil price crashes, and the Nigerian Naira loses 50% of its value against the dollar. All of a sudden, that debt you owe, in local terms, it